Hi, welcome to today's video. We're going to talk about, are you ready for retirement? Kind of an interesting topic because most people, when they think about retirement, the number one question is, do we have enough money to retire? But there's actually behind that a bigger concern, and that is, are we ready to retire? So I'm going to look at 5 areas to help you figure out if you're ready for retirement. I think some of them are self-evident, but there's going to be some surprises here you hadn't considered. Now, if you're new to my channel, I make videos on retirement planning, financial planning, estate planning for business owners, families, and individuals. So basically, if you're looking to figure out how to manage your money, how to grow your net worth, and how to protect it, you hit the right channel. Okay, let's get into this right now. So remember to subscribe to my YouTube channel so you don't miss another video. Okay, number 1. You've reached retirement age. Now, I want to be clear about when I say retirement age. Retirement age as it's defined by the government of Canada. So from age 60 to age 70 is where you're eligible to use your Canada Pension Plan and your old age security. So that's what I meant by you're at retirement age. Some of you have, working in the government or teachers and so on, you can reach retirement age with your employer, and you might be 53, 54, 55 years old, and so you can consider yourself retired. But what I'm talking about today is really about being eligible to receive your government benefits. You can see here on this slide this retirement income timeline. That age, the earliest age to receive your Canada Pension Plan is age 60. The latest age to take it is age 70. And on this slide here, you can see that your 100% government pension, so CPP, at age 65, the average monthly benefit is about $714, but the maximum is $1,200. Now, if you decide to defer that and take it at a later age, say age 70, you're actually going to get a 42% bump, so a bonus in the sense of they're rewarding you for taking it later. So that goes up to $1,709 or $20,000 per year. But if you take it early, you get penalized to take it early. So instead of getting that maximum of $1,203, it would be $770, very close to that average that we see right now. So you can get a sense that a lot of people either are taking it a little bit earlier, or they maybe don't have a lot of higher income earning years that contributed to their Canada Pension Plan. So that's a little bit brief summary on the Canada Pension Plan. Now, the second area is you're debt-free. Now, let me really again say what I mean by debt-free. I'm talking about not paying off your non-investment debt. So some of you have used lines of credit in your home to go and acquire other assets like condos or rental properties. I'm not talking about that. I'm not talking about you collateralizing your life insurance values to go ahead and use that to invest somewhere else. That's not what I'm talking about. I'm talking about your principal residence. You've paid down the mortgage. And another area to consider is, as you're getting closer to retirement, you might have these big leases on your lease payments on your vehicles. And maybe you've got 2 brand new vehicles and you're approaching retirement and you're still paying $800 or $1,000 a month on those vehicles. That's not something you want to carry into retirement. So pay attention to the timing that when you want to retire and when those big ticket items that you're still paying for, when you can get out of those. Unless you've got enough money in retirement to fund big car payments, that's another matter. But most people, when they go into retirement, they may not even need 2 cars. They might even get a smaller vehicle, right? Because they don't have to worry about driving big long distances and commuting to work and wanting to be comfortable. And now the car is more of a convenience to get to here and there, like grocery stores and going shopping a little bit, but certainly not, hour and a half commutes or 2-hour commutes every day. So you have to re-examine your vehicles as well. Number 3, you are now an empty nester. Now, what does empty nester mean? That means the kids have moved out. I love this slide. Our kids are so funny. They asked if they can move back in, and they pop some popcorn. It's amusing. And some of you can probably relate to that, of some of the frustrations of waiting for your kids just to move out, like this couple here. But we're waiting for you. Like, get on with your life. You can't really make decisions about downsizing, selling the house, moving into a smaller, maybe it's a condo, maybe it's just a smaller home. You really can't make those kinds of decisions if the kids are still there and they haven't moved on with their life. And I know it's difficult. I'm making, a little bit of a joke with that because I understand the frustration of having your kids still in the house longer than you'd expected because it's kind of holding you back. And we're doing everything we can for our kids. But just the reality is, are you ready to move on and are you ready to retire? Well, you might want to downsize. That might be your biggest source of retirement income is the house you're sitting on. So you really can't get into retirement until your kids move. So this is actually a very big planning issue for a lot of people. I walk my clients through looking at all their assets and helping them to see that because they haven't been saving enough in traditional investments, they've been purely focused on paying down their mortgage on their principal residence, that they end up having $1 million or more in equity in their home ready to go. But to access it, they need to sell it and they need to move on. And so this is obviously a serious concern for a lot of people. Okay, creating a retirement budget. I'm using that word, cringing budget, and a lot of people don't like the word budget. I don't really like the word budget. Nobody likes to be on a budget. But when I say budget, I don't mean it that way about, counting your pennies. That's not what I mean. What I mean is actually thinking about what it's going to cost you on a daily basis or a monthly basis, just to get a really good handle on that. Do we have enough money and what our expenses are? So this is kind of a surprise you might not have considered. Let's look at this together, okay? The first step is you want to examine what is your estimated income. Now you get that if you've got an advisor that you're working with, they can run a financial plan and they can share with you how much income is going to be driven through your investment portfolios, or you have retirement properties, rental income. Maybe you have a business that is providing an income stream while you're retired. Either way, you want to add up those income streams plus the Canada Pension Plan and Old Age Security so you know what your income is going to be like. Then the next step is you need to eliminate your work expenses. I know that sounds obvious, but some people actually, they're thinking the work expenses that maybe it's just the driving or the lunches sometimes that I take out. Well, it is the driving, it's the fuel costs. This idea that you're spending 1 or 2 hours a day commuting back and forth to work, that won't be there anymore. So that expense of your time is now being given back to you. Now, the other thing too is canceling subscriptions. So I'm going to share with you just my insight about my own profession. I have a ton of subscriptions. What do I mean by that? Online subscriptions to software, to websites, to Adobe software to be able to use PDF documents, DocuSign, sending documents back and forth to clients to sign. All of those kinds of things aren't necessary for me if I wasn't working as an advisor. And so what I would say to you is take out your bank statement, look through your bank statement and make mental note. If you're not retiring tomorrow, but if you've got some time ahead of you, make like a journal of when it comes time to retire, these are the checklists of things you have to go through. So look at your statement and look at the debits that are going through your account for those kinds of expenses that you've got. For example, one of the things that I have to do of having, and you can relate to this, when you've got a full house and all the kids are there, and let's say you've got 5 people in the home, and I'm working, I'm doing Zoom calls, I'm producing videos, and 5 people are connecting with 3 devices each, right? They got a phone, they got a laptop, they might have a TV in their room, and if you're working with Rogers or Bell, everything's like Wi-Fi now. And so you can imagine all these devices are sharing all of that space. So I have to have the highest speed and the most data I can get in my house, so I'm not running into a situation where I can't work properly. Well, when the kids all move out, I don't need to pay for that, and it's very expensive. So those are areas that you want to just pay attention to, eliminate them as you go into retirement. The next is your need for 2 cars. So many of you working need 2 cars because you're going in different directions. But when you're retired, you may not need 2 cars. Or maybe you don't need 2 big cars, you just need 2 smaller cars. Because after all, you don't need a really big, comfortable, sturdy, safe car to commute anymore. What you really need is a car that can get you to and from, let's say, the grocery store, doing some shopping, going to visit friends. You don't really need a robust vehicle, really safe vehicle, unless you're doing commuting back and forth to like Florida or something, but you can actually eliminate one of those cars. Okay, the next thing is you need to add in what you expect to spend on travel, vacations, like if you're going to be a snowbird or just doing occasional traveling. Dining out, you're likely going to dine out more. Activities that you're going to get involved in, so add those expenses in. And then the next one is helping financially. This is the last one on that list. Now, so many of our younger children, when I say younger, our 30-year-olds, might be struggling trying to get into their first home, or if they've managed to get into their first home and having daycare expenses, those bills start adding up. And so that's where, if you have enough money, and your financial plan will tell you if you have more money than you're going to spend, that's where you can now begin to help your kids. I'm not here to tell you what to do. I'm just here to give you suggestions. I'm not here to tell you how to parent, but I'm here to help you figure out how to use your money in a way that might be helpful just to you and also to your kids as they're growing their families. And that is helping to pay for daycare maybe, or maybe it's helping to pay for a vacation, or some of the expenses that might be associated with their house to make it a little bit easier. That you have to build into your retirement plan. And I know some of you have already figured that out, that you're going to have to help your kids. The next one, it's not on the list, but I just want you to pay attention to making sure that you're aware that if you have any medical issues, your poor health, you might need to change things around your house to make it more accessible to move around. So you might have to have some additional expenses in your retirement years to help you be more mobile, if you will. Okay, fourth one, and we're almost there. Portfolio review. Wow, this is a big one because a lot of people actually don't bother to do portfolio reviews. They just keep putting their money into the investment accounts. And then they get a year out and they go, do we have enough money to retire? Well, that's leaving you a little bit too late maybe. So the first thing you want to do is you want to talk to your financial advisor. I put this in every video. It's having a financial plan. It's seeing the outcome of your planning decisions before you commit to them. So powerful. Nearly every time I go through this exercise with my clients, first of all, they're just so relieved. They see their plan in action, and the stress level comes down, and they realize we're going to be fine. We have enough money. We actually have more money than we thought, and we can now include other areas that we really wanted to do, those bucket list items or charitable giving, whatever. They now realize they're going to be fine. So this is a very important step. The financial plan gives you something like this. This is showing you that your financial plan or your retirement plan is fully funded. So you have the ability to spend the kind of money you want to spend in retirement, and you're not going to run out of money in retirement. And also making sure that when you talk to your advisor, what are the data points that they use to actually develop this? Are they saying you need to get 12% rate of return in order for this to happen? Or is it a nominal, very achievable rate of return, like 4 or 5% will produce this? So that's very important. If you can get this done, you will have a very, very successful, stress-free retirement if you get this done ahead of time. The next thing you have to consider is, if you're not going to do this, you have to consider you're going to live a long time in retirement. Look at this. If you're 65 years of age today, or you're 65 at retirement, and you are healthy, the probability of you getting to age 75, if you're married, if you have a couple, 85 is 75%. So there is a big probability that you're actually going to live to age 85. So you're going to be in retirement for at least 30 years, we'll say. So you have to keep that in mind, that your money's got to last that long. Last one, number 5. This is a big one, guys. Can you believe this? Couples actually have conflicts over when to retire. This is more common than you think. And the reason for that is because of sometimes it's the age gap. One of the spouses, one of the persons in that couple is much older than the other one. So the older spouse reaches retirement well ahead of the younger spouse. They're ready, they put in their time, they've earned their right to retire. But the younger spouse is like, wait a minute, you're going to go play golf and I'm going to work in a very stressful job that I don't want to be in right now. That is a very, not a good dynamic to enter into retirement. And so a lot of couples need to talk about that in their financial plan and say, what ages do you want to try to retire? Because one might have to work 1 or 2 or 3 years longer than they plan to allow the younger spouse to catch up to an age. Now, it might not just be about that the person doesn't want to retire, the younger one doesn't want to retire. Maybe they really thoroughly enjoy their job. Maybe it's a business and they own this business and there's no succession strategy yet, or they just don't want to give up their job yet. So there's this dynamic, these discussions that have to be done. Or maybe they're working in a career where they have a pension plan and they can't retire until a certain age to be eligible to have their full pension. So this has to be discussed. It has to be in a plan, and you got to figure this out. This is so important. That's it. I love it. Got through this in less than an hour. I love it. I hope you enjoyed this session. I always say to people, we take care of your wealth management so you can take care of what's most important to you. This kind of session is really meant to help you to have a better retirement, to give you information that's going to make planning for retirement much easier. If you love this material and you found that there's a benefit to it, I'm sure other people would find that too. So go ahead and share that with everybody you know, people that would love to see this. Again, thanks so much for tuning into this channel. Thanks for taking your time to watch this video today, and I look forward to seeing you in the next video. Thanks very much and take care.